now um, we're going to talk about specific loan structures, like the types of loans that are available, what kind of options you have. Because and I think this piece is important because when you're in contract, it's exciting, but there's a lot going on. You know, you're in the contract, you're ordering a home inspection, you're doing all these different things, and then like, oh, in the middle of it, I have to decide about what kind of loan program I want, what's makes sense for me, what's suitable. So it's sort of like this compressed time of big decisions, right? So having an understanding about the different kinds of loans and how the options are and what makes sense for you and your family, I think is really good. Because if you have that kind of figured out ahead of time, I think you're one step forward. So the person who's going to be handling this piece of our presentation is Sylvia Satash. So Sylvia's she's a loan officer with UNFCU. She's been in financial services for over 25 years. Her focus is on new construction and 1 to 4 family residential lending in the Washington, D.C. market. So she has a lot of experience with builders and some of the nuance around that piece of the home buying experience. Like all of our loan officers, her number one priority is delivering seamless process with high customer service. And Sylvia is a former board member for the Prince William Association of Realtors and also a recipient of their prestigious Affiliate of the Year award. So, with that, Sylvia, please take it away to our next segment.
Thanks, Mike. Good morning, everybody. I'm going to talk to you about the different types of mortgages. Actually, there's really two different types of mortgages. Can we have the next slide, please? The mortgages fall into two main categories: fixed rate mortgages and adjustable rate mortgages. Each works differently, and borrowers benefit from different options that they can select. Next, please. Fixed rate mortgages are exactly what, excuse me, I've been fighting a summer cold. Fixed rate mortgages are exactly what they sound like. They're fixed. The principal and interest does not change. But I do want to mention that the taxes and insurance, they can change over the life of the loan, and that can make your payment go up. So you need to be prepared to look at your mortgage statements at least on your anniversary date, because you could miss a payment adjustment because your taxes went up or your options. So we will allow you to pay any increase so you can keep your payment the same. It helps with long-term budgeting, and it protects you from rising interest rate environments. Next slide, please. Adjustable rate mortgages are exactly what they sound like. They're fixed for a certain period of time. Usually the most popular are 5 and 7 year, 5, 6, and 7 year, where it's fixed. There's no change in principal and interest. And then at the end of the fixed rate period, the monthly payment can change. Typically, there is a lower start rate, whether it be for the 5, 6, 7, or even 10 years. And then the interest rate will adjust based on market conditions. Next slide, please. The initial fixed rate period, as we mentioned, could be 3, 5, 6, 7, and 10 years. Those are the various adjustables we have. After the fixed rate period, there's an adjustment frequency. In other words, how often can it change after the fixed rate period? The arms that we use adjust after the fixed rate period. They adjust every 6 months. We use an index. That's the market benchmark of what the adjustment is based upon. We use the SOFR, which is the standard overnight financing rate. And this is the index used by most mortgage companies in the U.S. right now. And then they take that index, which is the SOFR, and they add what's called a margin. That's what they add to determine the next year's rate. So they take the SOFR, whatever the reading is at that time, they add a margin, and that determines the next interest rate. However, there's some protections built in. There's caps. So it just can't wildly go anywhere. There are interest rate caps on what it can adjust to on the first adjustment and subsequent adjustment and overall life cap. Next. For example, a 5/6 arm. A 5/6 arm would be fixed for 5 years, and at the end of 5 years, it would adjust every 6 months. Again, they would take the index plus the margin, and that would be the next period's interest rate. However, the caps would stop it from going above a certain point for the first adjustment, and then each subsequent adjustment and the overall life of loan cap. Next slide, please. There's many common ARM myths regarding ARMs. People think they're risky. There's certain protections built in on qualifying on an ARM. For example, if you really like the rate on a 3-year, you're going to qualify at a slightly higher interest rate just to make sure you can handle that adjustment. So the risks have been pretty much filtered out because of the qualifying process. Another myth is that the lender can change the interest rate whenever they want. That is not true. It is set out in your note on when it can change and what are the terms. ARMs are always the cheapest option. Not true. They can be, but they may not be as well. So it's going to depend on how long you're going to be in that property and if that would be a cheaper option for you. And then the final one is the ARMs caused the housing crisis. Bad underwriting caused the mortgage crisis in 2008. They did a lot. There were a lot of no qualifying, tell us what you make and we'll believe you and we'll write it down. A lot of risky loans were written in 2000 in that period, and that's what led to the collapse of the mortgage market. Next slide, please. What is the right choice for you? This is a big question, and this is something to really think about before you write a contract. You could benefit from an ARM if you expect to live in the property for a short period of time. You're likely to expect to receive a cash windfall. You got a bonus coming in. One of the most common things that I see is we have one spouse that is not working. They're in school while the other one is working. So they expect a second income, but that's not going to happen for a year or two. That is a classic candidate for an adjustable rate mortgage. Now, for somebody for a fixed rate, if you come in and you say, this is my forever home, I'm never going to move, I'm going to say, okay, and I'm going to recommend a fixed rate mortgage. But I ask everybody to think about where they were 5 years ago. Where were you in your income and your life? Because things change very quickly. And that's really important to remember, that not everybody's going to live where they're going to purchase for the rest of their lives. And then if you have a fixed income, that would be something that you definitely don't want to take on an adjustable rate mortgage. You don't want to have any volatility down the road. Next slide, please. Closing costs and points. Okay, closing costs are a cost of getting the loan to the settlement table. And as a general rule, you can expect to pay 2% of the sales price. And that's just for closing costs. There are also escrows and points equal 1% of the loan amount. That is probably the least understood factor about closing costs. People just don't understand points. It's nothing more than 1%. So if you have a $400,000 loan amount, it would be $4,000 at the settlement table. You really have to figure out the difference in the principal and interest versus the cost of the point and figure out how long that buying down that interest rate or paying that point, because that's what a point is. It's buying down the interest rate. Next slide, please. Here we go. Whoops. Okay. There are different types of closing costs. Lender fees. There's direct lender fees, such as underwriting or loan origination fee, or there's third-party fees, such as an appraisal charge, credit report, flood certification. Those are all contracted services that we hire out and you pick up the tab. Title companies the same way. They have their own fees And they also have third-party fees such as title insurance, survey, etc. Also, recording charges. Those are charges from the local courthouse to record ownership of your property. And then tax stamps. This is a wide one. They fall into so many different categories. There's some have congestion relief stamps. They have mansion charges. There's so many different tax stamps, but these are set forth by the local, state, and county or municipalities. And then an escrow, that's an account. Just think of it as a checking account to pay your future bills. And that's collected on your behalf each month. And it's literally your annual taxes divided by 12 as a general rule. Now, if you have a shortage, which can happen if you're paying less than what you're being charged for taxes, there's something called an escrow shortage, but that your loan officer can explain to you. Next. Okay, points can be charged as interest rate, resulting in a lower. Can be an upfront interest charge resulting in a lower rate. You can also receive points as a credit, which can offset your closing costs. But under no circumstances can you use those points for down payment. So the points make sure that your points don't exceed your closing costs, which can happen, or your credits. Next slide. The bottom line of all of this for loan programs is no two borrowers are the same. What's good for your coworker may not be good for you. Do not focus on interest rate alone, and take a look at the points, drill down, see if the difference in the costs really merit paying those points. And that's it.
Sylvia, great job. A lot of great information. Couple quick questions. So there was a slide earlier. We talked about adjustable rate mortgages, ARM products versus fixed rate products and the suitability for that. All things being equal, I guess you'd take the fixed unless you're going to get some rate benefit in an ARM. So like if the adjustable mortgage is 0.5% lower and that makes things more affordable now, that might be a reason for somebody who also meets your other scenarios with increased income and so forth. But I guess in terms of like, are they dangerous or scary? Like as a portfolio lender, UNFCU, we do quite a bit of ARM loans, and our portfolio delinquency rate, I believe, is less than 1%. It's like less than one half of 1%. So that's a good thing in two ways. One is, as a lender, obviously, the loans are being paid on time, and that's good. That's what we're in the business of doing. But also, it kind of shows, I think, that our we have a good process. Even though we're flexible, we have a good process to make sure that our members
protect the member.
Yeah, we protect our members, and we know that they have the ability to repay, and they do repay. So my question is, if I took an ARM loan, I'm saving that that amount of money each time, but then I want to get out of it. I want to refinance it, or I want to do something else to get out of it. Is there a penalty, or am I stuck in that loan?
We don't offer. None of our products have any prepayment penalties whatsoever.
Okay.
You can refinance, and we even offer on our portfolio ARMs, we offer what's called a modification, which is post-closing. We will offer a lower rate for a fee, provided the payment and the interest rate are less than what's currently being paid.
So let's talk about that a second. So if I take a 6-year ARM, for example, and I'm 3 years into it, and the interest rates in general are lower, I call up customer service and see if they can offer me a lower rate, and then what happens?
Yep, you can call me.
Okay, call you up. Okay.
Yeah, absolutely. And what will happen is they will take the remaining 27 years and they will amortize the current balance over the new interest rate. And as long as that payment is lower and that interest rate is lower, there could be a benefit to the member for it. Like I said, it's right now, it depends on the loan amount as to the fee, but it ranges between $1,500 and $2,500.
So if it's under $1 million loan size, if I owe like 500,000? How
A
it'll be 15?
$1,500 charge, one-time charge. You could literally be unemployed. In fact,
Now,
during
well, that was my next question. So do I have to qualify for that other than
no
paying the fee?
appraisal, no qualification, the only stipulation is you must be at least 6 months into your loan,
Okay,
and you must be current for the prior 6 to 12 months.
got it. So as long as
So
I'm good
if it's a brand
citizen
new
and
loan,
paying
it's
on
6
time?
months. Yeah, paid on
All right.
time. That's defined as no 30-day lates.
So now I have a 6-year adjustable. I'm doing this after 3 years, so I have 3 years to go. So once I've completed this process and lowered my rate, do I have 3 years left at that point
No, you
with the
start your
fixed
6
interest?
years you start the 6-year fixed rate period all over again.
Oh, okay. So really, I get 9 years then,
You
right?
get
Three
9
at the
years. Yeah.
okay
It's a
in that
great
example.
product. It's a
Okay.
great program and not too many companies offer this a post-closing modification for improved rates. They offer them for having trouble making the payments, this is not for. This is for somebody that wants to refinance, but they don't want to go through the pain again.
And I would make this point, and this is more general, but like we're a credit union, we are a non-for-profit, so we exist for the benefit of our members. And
Correct.
when folks get a mortgage from us, they're a member, and we're looking to take care of them. So that's why these sorts of, and there's many other little features we
Exactly.
do, but I think that's a really good call out, Sylvia. Really good. So great job. That was good information. And if we can move on to the next slide, please.